So switching over to aluminum, I know we talked about this chart specifically, which has the relative strength index down at the bottom of it. Again, as a reminder, the relative strength index is sometimes used by traders as a gauge of momentum. I think last month when we looked at this chart, things were pretty darn oversold, and the relative strength was actually below 30, which was that green line shown very faintly down at the bottom of this chart. But no doubt about it, over the last 3 months, with China being locked down, with the stronger dollar, with the Fed hiking rates, we've had a pretty aggressive storm that's brought prices back down to earth in a very quick fashion. Now, the question is, are we beginning to trough out? There are some things that would suggest that we're beginning to find a little bit of consolidation around these levels. So we got as low as about $1.05, let's call it, and we're currently sitting at about $1.10. I do want to cite this chart, which is a new one for us. So I want to take a minute or two to describe what we're looking at. This is what's called a cost curve. And I'm not trying to insult anybody's intelligence, but I do want to make sure it's understood. A company called Wood Mackenzie puts this together. And what they do is they're literally going out to every single aluminum smelter in the world. And they're saying, how much aluminum are you going to make? How are you going to make it? What's your cost structure look like? And then they're constructing this curve based on how much it costs those producers to make aluminum. So as we look at the x-axis, left to right, that's essentially how much production capacity of aluminum there exists in the world today. So let's call it roughly 70 or 80,000 metric tons of smelting capacity. Looking along the y-axis on the left-hand side, that is the cost of production for making that aluminum. You can't see it, but going left to right within this data is a smattering of all the various producers who produce aluminum in the world. Not every smelter is created equal. Some have really good power contracts. Some are using hydropower. Some don't have power contracts, and you can see that on the far right-hand side, what that impact can have to their ability, or in this case, inability, to profitably make aluminum. What I've drawn into this chart is that dark blue dot, which is basically where aluminum prices exist on the LME right now. And I know it doesn't look like much when I cite this, but the cost curve's pretty darn flat, working anywhere from about 20,000 tons all the way up to where we are. And what I mean by that is, if prices keep dipping lower and lower, in a pretty quick fashion, the market ends up making a lot of smelters unprofitable. As we sit here today, it's estimated that roughly 23% of smelting capacity is underwater or loss-making. So what happens when smelters become loss-making? Well, they can hope and pray and hope that prices go back up and they eventually start making money again. Or a rational economist would say, in a medium-term situation, if prices stay around where we are, those producers who are far on the right end of the cost curve, they end up shutting down. So you end up getting this pseudo inherent floor in the price of how low aluminum can actually go, because if you start going too low, more and more smelters become unprofitable. And to put that into perspective, again, I mentioned the fact that the cost curve is really flat here in this area. So we're at $1.10 right now. If we drop to $1 on an LME basis, that goes from making 23% of aluminum smelters unprofitable to making over 50% of aluminum smelters unprofitable. So all of a sudden, you really start to raise the question of how many of these smelters are going to continue producing if prices stay down, even in this area, let alone go 10 or 15 cents deeper from here. So I think it's an interesting scenario. It doesn't always play out exactly the way the economists think it does, because sometimes production will stay online and produce at negative rates for short periods of time. But if you see that persist for 3, 6, 9 months, you end up getting a lot of smelter shutdowns. And already some of those smelters over on the right-hand side of that dot have announced production curtailments. So that I guess my point is that could provide a little bit of price support here in this general area of prices for the LME aluminum. What we're looking at on this chart is kind of the reverse scenario, which is it looks like there could potentially be further pain on Midwest premiums. Again, Midwest premiums is the premium to get aluminum ingot into the Midwestern portion of the United States. Two big factors that are driving the Midwest premium lower. One is the fact that LME aluminum has dropped. When you have a 10% tax on that material, which we do, the impact of that tax actually declines, which makes the premiums drop. The other notion is what's shown in this graph, which is looking at trucking rates. So this is the truckstop.com flatbed truck rate. And you can see that the correlation is not perfect, but there is a general relationship between trucking markets, logistical networks, and Midwest premiums. And you can see where trucking markets are ultimately going, which is they're loosening up. The bottlenecks that we're seeing within the flatbed trucking industry appears to be normalizing in a fairly quick fashion. And assuming this relationship holds up, we should continue to see Midwest premiums creep lower. So a little bit of good news to potentially offset a little bit of that price support that we might see on the LME.